Good morning. Today is December 17th, 2024. It's 9 a.m. Mountain, and we're doing the Triple R deliberation in the Public Service Company gas rate case, proceeding number 24AL-0049G. Mr. Davis, Mr. Mendelson, I think we're going to start with the WAC.
Okay, good morning, commissioners. I'm Ron Davis of the Commission's advisory staff, and yes, I'm joined by Mike Mendelson and Juliet Akamboa, who are the Commission advisors, and Ruthie Harper is in this Zoom session to help us as Commission counsel. We're going to take you through the decision points raised by the applications for rehearing, re-argument, and reconsideration, specifically to the decision number C24778. By that final rates decision, the Commission established new base rates for all retail gas service provided by Public Service Company of Colorado. There are approximately 30 decision points raised in the Triple R that was filed by Public Service, by trial staff of the Commission, and by the Colorado Office of the Utility Consumer Advocate. And we'll try to move through these at a good clip. And for the items where we anticipate that there may be discussion, we will set up the decision point and pause, but in other instances, we'll move to a recommendation if that's okay with you. Okay. And because the Commission has told the clock so that the Triple R was not automatically denied yesterday, we can also bring back matters to tomorrow's weekly meeting if you have legal questions or want to talk to advisors privately about something that comes up during the deliberations this morning. And we can also take a break. And unless the commissioners have anything they'd like to say before we start, we'll jump right into them. In the interest of saving time, Mr. Mendelson will present the first decisions addressing the Triple R directed at Public Services Weighted Average Cost of Capital, or the WAC.
Let me just check with my colleagues to see if they want to say anything. I don't have anything to say, but Commissioner Plant.
Good to go.
Commissioner Goman.
Nothing, thanks.
All right, Mr. Mendelson, if you want to take items 1 through 4 maybe together, I think that might be appropriate.
Sure. Good morning, commissioners. I'm Mike Mendelson of your advisory team, and I'm here to present and frame the Triple R arguments related to WAC section of the decision. Early in the decision, the commission set out 3 principles it deemed as key guidelines in their evaluation process. First, the commission found it appropriate to evaluate ROE and capital structure that comprise WAC in a combined, holistic manner rather than through isolated evaluations, as these items are highly interrelated. Second, the commission found it reasonable and appropriate to place meaningful weight on the financial integrity of public service directly, as measured by projected credit metrics commonly applied by rating agencies, in addition to traditional analysis of ROE and capital structure. Third, the commission found that the company should be evaluated as consistently as reasonably possible as an operating company, as there are important distinctions between an operating company and a holding company, evidenced by the unique attributes of public service and its parent holding company, Xcel Energy. With that background, the commission found that a WAC value of 7.0% will result in just and reasonable rates that are in the public interest. The commission further concluded that the pre-existing ROE range of 9.2 to 9.5% and the equity ratio range of 53 to 55% are well within the credible record evidence in this proceeding, and as evaluated in 2 separate financial models, support the company's financial integrity and align with the other aforementioned principles. In its Triple R, Public Service raised several issues with respect to return on equity, capital structure, the cost of debt, and that the final WAC be mathematically achievable given the component ranges authorized by the Commission. UCA also brought an argument with respect to the cost of debt. Advisors have broken down the discussion today into 4 prompts, which I'll ask you to deliberate on. However, due to the interactive nature of the WAC components, I'll suggest to the commission withhold any specific votes until all the material is presented. The first set of issues surround the setting of ROE. Public Service argues that the commission's ROE findings reflect no increase in the range adopted since the company's last rate case, even though all market evidence and all parties' models indicate an increase is warranted. Public Service suggests that there is no credible evidence in the record supporting an ROE range of 9.2 to 9.5% and requests the Commission increase the floor to at least 9.4%. Public Service also argues that the Commission's decision lacks the required inquiry of whether the authorized rate of return is reasonable relative to utility companies of comparable risk as Hope and Bluefield require. With respect to parties' testimony and analysis, the company argues that the decision does not reflect the fact that staff witness Dr. Deepu rejected his own constant growth discounted cash flow model, or CGDCF, of 9.6%. They also suggest Dr. Deepu applied outdated stock price data and inappropriate growth rates to his multi-stage DCF model, and then ignore the results of that model since they were too low to account for investor expectations or peer authorized ROEs. Public Service suggests that simply fixing Dr. Deepu's errors increases staff's average DCF to just over 10%. With respect to UCA's analysis, the company suggests the decision failed to reflect the fact that Dr. Fernandez admitted at hearing that his ROE modeling suggests a range of 9.4 to 9.7%, even before corrections related to his proxy group criteria. Once the proxy group is corrected, Public Service suggests Mr. Fernandez's models support a range of 9.7 to 9.8% ROE. The company also argues that authorized ROEs by other commissions have increased substantially since the company's last gas rate case, from 9.38 in early 2022 to 9.81 as of June 30th, 2024. At this juncture, advisors would like to note 6 points related to the commission decision on ROE. First, with respect to Public Service's claims that Dr. Deepu rejected his own CGDCF model results, advisors note that he merely cautions that there are dangers in analyzing a single firm stock with the constant growth DCF formula. He then opines that using the MS-DCF model is more reliable on account of flaws he perceives in the CGDCF model. Advisors suggest such caveats and opinions should not render his CGDCF model results irrelevant. Second, with respect to complaints, the decision failed to consider potential mistakes in Dr. Deepu's multi-stage DCF model. Advisors note that, like Public Service's witness, Dr. Deepu presented the results of numerous models. As mentioned, he conducted the CGDCF model and did so through several variants on both the gas utility and diversified proxy groups identified by Public Service. Through those exercises, he calculated average ROEs between 8.9 and 9.27%. Third, Dr. Deepu also conducted the CAP-M model and raised important questions with respect to beta, which is the measure of a stock's price volatility, as well as the risk-free rate. In particular, staff presented considerable evidence that beta itself is quite volatile, depending on 3 key facets of how it's measured: the length of the historical data, the frequency of the sampling, and the market index the analysis is conducted on. Ms. Bulkley conducted her CAP-M modeling on 2 sources of beta, Value Line and Bloomberg. Staff presented 3 additional sources of beta, S&P, Yahoo Finance, and Zacks, all credible sources that calculated betas roughly 1/3 lower than the Value Line and Bloomberg for each member of the proxy group. Dr. Deepu also calculated his own beta by applying daily data. Public Service disavowed that approach, arguing that utilities are too thinly traded to rely on daily data. The Value Line and Bloomberg are highly reputable and widely used sources. Advisors note that even ignoring staff's own beta calculation, the CAP-M results are highly variable based on the beta selected. Applying the 3 sources of beta that Public Service excluded produces an ROE of 9.0%. Applying all 5 sources of beta produces an ROE of 9.36 median to 9.52% average. With respect to the risk-free rate, in her rebuttal testimony, Ms. Bulkley indicated an updated risk-free rate sourced from Blue Chip Financial was 4.32%. If that risk-free rate is incorporated and all 5 sources of beta are applied, advisors calculate an average ROE of 9.34 and a median of 9.17, essentially at or below the ROE range authorized by the Commission. Fourth, with respect to Mr. Fernandez's modeling results, his answer testimony indicates that his constant growth and multi-stage DCF models produce results as low as 8.4 and 7.8% respectively. Mr. Fernandez also points to the fact that Ms. Bulkley's DCF models produce results as low as 9.16%. Fifth, all of the analysts in the instant proceeding conducted their DCF models on holding companies. As the commission noted, among its stated principles, holding companies generally maintain higher proportions of debt than operating companies such as public service, and thus are somewhat riskier investments. As noted in the first deliberation for this case, Excel's additional leverage enables it to produce higher return on equity values than the underlying operating companies that comprise it, such as public service. Sixth and finally, the commission made specific efforts to include Xcel Energy's communications to the investor community as part of the instant record. The September 2024 investor presentation suggests the company will provide equity investors a return of 9 to 11% based on 3 to 4% dividends and 6 to 8% earnings growth. An earlier investor presentation from 2023 suggested a total range of 8 to 10% to Excel's equity investors. Nevertheless, the 9.2 to 9.5% authorized ROE in the instant proceeding is well within what the company communicates to the investor community. And again, that is for Xcel, the holding company, which maintains far higher debt levels than public service and operating company. So the decision point before you at this for the ROE section is, should the commission increase the floor of the ROE range to at least 9.4% or otherwise expand the discussion supporting an ROE range of 9.2 to 9.5 as requested by public service? I'll pause here for discussion or can answer any questions, or I can proceed with the other elements.
I think I'd like you to proceed, if that's all right, with you guys get all four on the table and then come back with talking about all four at once. Or do you have any questions for Mr. Mendelson at this point? So Commissioner Plant, you okay proceeding? Commissioner Gellman?
Yeah, I think some of the other issues brought up kind of relate back to ROE, so it probably makes sense to talk about them all at once he's done presenting.
Okay, keep going, Mr. Mendelson.
Alrighty. So the next WAC item is actual capital structure. As mentioned above, the commission determined that the pre-existing equity ratio range from 53 to 55% is well within the credible record evidence presented by the parties and supportive of the company's financial integrity. Public Service argues that the final rates decision does not align with case law requiring use of actual capital structure. Specifically, Public Service claims the WAC should be updated to reflect a 55% equity ratio in line with the Colorado Supreme Court decisions referred to as Peoples Natural Gas. The Peoples decision states that a guiding principle of utility regulation is that management is to be left free to exercise its judgment regarding the time of entering financial markets and its judgment regarding the most appropriate ratio between debt and equity in the capital structure. It also says, unless it has been demonstrated by a substantial showing that ratepayers are materially prejudiced by the actual capital structure which finances utility operations, the PUC should use the actual capital structure in calculating rates. The decision also says, however, that the commission is where the commission is trying to ascertain the actual capital structure of a subsidiary that does not have an independent corporate capital structure, it is reasonable for the commission to make some adjustments to the corporate structure of the parent in arriving at that imputed capital structure. Advisors note that the company requested a 55% equity ratio, and the commission authorized a range which extends to that 55% equity ratio. Although not specifically specified directly, it appears the company contests an equity ratio authorization of anything below 55%. As mentioned above, the commission specifically discussed the interdependency of capital structure and return on equity and need to evaluate these items in concert. Further, advisors note the proxy group relied upon by public services expert Ms. Bulkley are primarily financed with debt. Based on data provided by staff, advisors calculate that the proxy group maintains a 54% debt ratio on average and a 58% debt ratio on at a median value. This means the remainder capital 42 to 46% is financed with equity, a far riskier capital structure than authorized by the commission's decision in this instant proceeding. Notably, the company also evaluated the capital structure of the proxy group, but limited its analysis to the operating companies of those corporations, thus excluding holding company debt. So the prompts for this section is: should the commission use the company's actual capital structure or otherwise explain why the range adopted by the commission is consistent with case law? The next item is with respect to the cost of debt. In the final rates decision, the commission adopted the company's suggested cost of long-term debt at 4.27%, even though that measure included debt issuances in 2024 after the test year period. With respect to short-term debt, the commission rejected UCA's suggestion to eliminate short-term debt from the capital structure and rejected UCA's suggestion of 1% return on short-term debt, explaining, however, we agree with UCA that using a cost of short-term debt at the 5.81% level is not reasonably representative of the cost of short-term debt going forward, given recent actions and indications by the Federal Reserve to reduce interest rates. Because we expect the cost of short-term debt incurred by the company to be below the 5.81% level, when the new base rates established by this decision take effect, the full use of the authorized ranges for ROE and the equity ratio will mathematically support the calculation of the authorized WACC at 7.0%. Public Service contends in its RRR that it requires an established cost of short-term and long-term debt to calculate its revenue requirement. They seek clarification whether the commission intended to approve the company's actual cost of short-term debt at 5.81 or to modify the short-term debt rate to an arbitrary number such that all facets of the WACC are within the specific costs and ranges adopted by the commission. UCA also challenges the cost of debt findings in its RRR. UCA claims the commission was inconsistent in the manner in which it treated the cost of long-term and short-term debt. UCA notes in its answer testimony it recommended a long-term cost of debt of 4.04% for the 2023 test period, which is based on Public Service's actual cost of debt at that time. UCA opines that if the commission is inclined to accept 4.27% for the cost of long-term debt due to the new post-test year debt issuance of $1.2 billion, then the cost of short-term debt should also be updated and reduced to no higher than 5.18, which was unrefuted testimony provided during the hearing. Advisors note that Mr. Fernandez mentioned at the 9/12 hearing that the Treasury yields had declined to 5.18% as of the prior day, but that Mr. Johnson also indicated applicable commercial paper rates were in the 5.5 to 5.6 range at the time of hearing. UCA argues the commission should apply consistent treatment for both types of debt, by applying the actual cost of short-term and long-term debt at the ends of last year. So the decision point on the cost of debt is should the commission set a specific short-term debt as requested by Public Service, and if so, should the commission agree with UCA to set the cost of short-term debt at 5.18? Alternatively, should the commission set the cost of both long-term and short-term debt at the end of the 2023 historic test year, as initially recommended by UCA? And then the final issue related to WACC is that the WACC mathematically computes based on the component findings. As mentioned above, the commission authorized a 7.0% WACC based on a range of 9.2 to 9.5 and an ROE range, an equity ratio range of 52 to 55%. Public Service in its RRR argued that mathematically the commission's 7.0% WACC does not enable the company to adopt a 55% equity ratio, its actual cost of debt, and an ROE within the 9.2 to 9.5 range. According to the company, putting the pieces together leaves the ROE at 9.17%, meaning that a 7.0 WACC does not fully account for the increases in the cost of debt since the company's last gas rate case. Also, as described above, the Public Service requests the commission set the ROE range to no lower than 9.4. Advisors note that if the commission maintains the 55% equity ratio and other components, the 7.0 WACC allows an ROE of 9.183%, according to our calculations. So the specific prompt on this item is, should the commission modify any of the WACC components so that a WACC of 7.0% can be mathematically calculated? Or in the alternative, should the commission modify the WACC so that it is mathematically possible to incorporate the ranges of the equity ratio and ROE established in the final rates decision? So I'll pause now for your discussion and can answer any questions.
Yeah, I'll share share some of my thinking, and then really curious to see where you guys are coming from. So the company, as Mr. Mendelson said, asked us to reconsider our decision on ROE. In response, I went back to the record and looked at each of the individual arguments that the company made in its RRR, as well as the broader record on ROE. And in isolation, I can understand how the company views the 9.2 to 9.5% range as perhaps a bit below the level of its peers and toward the lower end of the range that would otherwise be supported by the record. But for me, the ROE decision is part of an integrated rate case decision package, including the fact that we raised WACC by 30 basis points since the last rate case. Our decision also incorporates a common equity ratio, which I believe may be at the upper end of the range supported by the record evidence and perhaps higher than the company's peers. As such, I don't believe the ROE decision should be considered in isolation. Rather, it's part of an integrated WACC package that also includes a common equity ratio. And it seems clear that the common equity is raised at the holding company level. And given that the holding company has a common equity ratio in the mid-40s, the 52 to 55% operating company common equity ratio we authorized appears to be at the upper end of the range supported by the evidence, and perhaps higher than the ratios used by many of the company's peers. For me, I was persuaded by company witness Mr. Johnson seemingly overriding and primary request to adopt a higher range for the common equity ratio to help maintain the company's credit metrics. A higher common equity ratio is perhaps the strongest tool to do that, since it both raises the numerator and lowers the denominator of the credit metric. So in sum, for me, arguments in the record suggest the authorized common equity ratio may be a bit above the company's peers and the ROE is somewhat below. On balance, however, I believe this compromise rents a good outcome for both the company's investors and its customers, as it maintains the company's financial integrity and credit metrics at a reasonable cost. Given the interplay between these various components, for example, if we were ordered by a court to raise the ROE on remand, I might want to explore lowering the common equity ratio to maintain the overall balance of our decision, if appropriate, at that time. So I would decline to alter the ROE range on this record. In regard to debt costs, in its RRR request on debt costs, UCA argues that we've created a mismatch by using a 2023 historical test year, a short-term debt cost from 2023, and a long-term debt cost that includes 2024 issuances. I agree with UCA that there's a mismatch, but would not adopt its solution of adjusting the short-term debt costs. Instead, to make the data more consistent, I would lower the long-term debt cost to 4.05% as put forward in the company's direct case and exclude the 2024 long-term debt issuance. This results in a 2023 historic test year with both long and short-term debt costs based on 2023 data presented by the company in its direct case, and provides a consistent approach for calculating the cost of debt and the test year. Taking all of this into account, I keep the WACC at 7%. With these adjustments, particularly the lower long-term debt number, it now becomes mathematically feasible for the company to hit a common equity ratio of 55% within the ROE range, which seems to be their desire and was another company RRR request. I believe these adjustments are responsive to the issues raised on RRR as a whole and work together to yield just and reasonable rates. Finally, I would adopt in our final order on RRR the analysis included in Mr. Mendel's presentation on all three items: ROE, capital structure, WACC, and the debt costs. So with that, I guess I have a relatively small preference for adjusting long-term debt back to 2023 and have struggled a little bit with the basis for setting the short-term debt. Commissioner Plant, really curious to hear where you want to go.
Yeah, no, that makes sense. I think that the approach is, that we take is one that optimizes the ability of the company to manage their business, and so I think it's very much in line with the case law that they quote. And I think that we do that actually more than most other commissions. We allow them that ability to manage their credit rating and make adjustments as necessary. And I think it also reflects, the changing nature of the markets and allows them to manage within that, which I think is the appropriate thing to do. Yeah, I think, honestly, you're going to have a much better view of this than I do because you have a little more historical perspective. It seems like we either go with some sort of consistent 2023 number on both debt and the revenue requirement, or we allow the debt costs to change in 2024 against the 2023 revenue requirement. And I don't know if this is if this is technically a sort of a consistency issue or as it relates to traditional rate making and matching principle sort of stuff, or if that's something that's commonly done in terms of taking different dates based on different numbers. But I think that at the end of the day, I think our 7% WACC was an appropriate level for us to set. As we maintain that, I think we're representing the cost to consumers at a reasonable level, while allowing the company to manage within their necessary financial metrics. And so I would accept that approach of moving back to the consistency with the 2023 numbers.
Commissioner Goman, I think you may have more history than either Commissioner Plant or I, so curious to hear what you're thinking.
Yeah, I mean, your general kind of sentiment that this is a package and therefore, it's really the reasonableness of the total outcome that matters. I'm completely on board with like that as a general sentiment here. And I think providing, that's part of the reason we've provided these ranges, so that the company can manage their credit metrics in a way that essentially holds the ratepayers harmless as to the best way that they can identify to kind of maintain the best credit metrics within reason in those operating conditions. I'll probably like reading the writing on the wall. I don't know how long we're going this morning, but if we go to a break, I might want to talk to counsel and advisors about the adjustment of the long-term debt piece back to the direct case, to really understand. I mean, I like and dislike the consistency of it. I certainly like the idea of keeping everything 2023, yet I think it sounds like for both long-term and short-term debt, there are more recent values to give you a more accurate recent indication of what the market does. And so just talk through kind of the pros and cons of the approach with regard to consistency versus kind of the latest, perhaps most accurate information. I'd probably benefit from discussing with them, whether that's at a break today or in advance of the CWM tomorrow. So that's the one point that I would benefit from taking a minute to discuss with advisors.
Would you like to take a 15-minute break now? Um, and um, I'm really actually good either way. I was just struggling with the number. Mr. Fernandez used a 1 month debt rate at the time he testified, which was 5.18. And now that number is like 4.5. It's down like 60 basis points. It's really volatile. So the reason I latched on to the long-term number because it was in the company's direct case and it's a 2023 number. So it seemed to have a basis in the company's testimony. But the math works better by adjusting the short-term debt. The ranges work better with the short-term debt. So I'm good either way. Would you want to break and talk to advisors, or you want to take it up tomorrow? I mean, we got
Mr.
so much
Davis
more.
thinks works best. I mean, we got a long way to go still today, so I don't know if we want to burn 15 minutes since we can just bring this back tomorrow. Should we move on to other points today and let this one sit for tomorrow, and I'll find the time later today to meet with them. I don't know. I guess I'd kind of look for Mr. Davis's advice on how time is best spent, and if I mean, to the extent we need to decide on this before we get to the other things, then we break and do that. If it doesn't seem like we do, I think we could move on and just come back to this point tomorrow. So,
Mr. Davis, any advice?
Well, I think the main question that Commissioner Gilman has raised is about the determination of the debt costs. I'm curious about what you think about the 7% WACC and whether you're sharing the view of Commissioners Blank and Plant regarding the desire to hold to that value, or if you are instead thinking about modifications to the WACC. I raised that because certain other decision points that follow might have bearing on what is decided for that rate of return. Specifically, the next item I would be presenting, and that is the valuation of the rate base.
No, it would be my desire to stick to the 7% WACC. But with regard to the fourth point as to how exactly the math works and what long and short-term debt costs were including in there, I think I could benefit from a discussion with you and council.
Okay, well, I think we can proceed then if your colleagues agree and if my colleagues don't speak up now.
So I guess the suggestion on the table is to leave the short versus long-term debt until tomorrow. We'll just bring back this one item, and I guess it's easy enough to put this rate case on the agenda for tomorrow, and hopefully we can take it up tomorrow for 10 minutes. Does that work for you, Mr. Davis?
Yes, definitely.
All right, let's keep going.
And it'll probably be the cost of debt clearly, but then like how the calculation works is impacted by that. So
correct. And the math works better by adjusting the short-term debt than the long-term debt. But that'll give you a chance to play around with the spreadsheets and talk to council and advisors.
Thank you. I'll find some time to do that today.
All right, Mr. Davis, item 5.
Okay, Mr. Mendelson turned off his camera, so I think
he's had enough.
He's had enough, and he'll have me go ahead. Okay, so consistent with what you've just discussed, the paragraphs 27 through 31 of the final rates decisions really explains the holistic approach the Commission took in rendering its decision in this proceeding. The Commission states that it approached each interrelated decision cognizant that as the revenue requirement increases, so do rates, and thus each decision requires the balancing of a fair return for the company with reasonable rates for customers. And in that vein, the Commission found a 13-month average rate base valuation is appropriate for the reasons set forth by trial staff and the UCA in their advocacy in this case. The final rates decision also states that except for the specific findings in the 2022 gas rate case, the Commission has consistently authorized a 13-month average method. The Commission was further unpersuaded to adopt the year-end convention in this case, finding that Public Service had not provided sufficient evidence to support its contention that a year-end method was necessary to advance the public interest. The Commission further explained that it was disappointed by the slow pace of change in the company's investment practices since the start of the energy transition here in Colorado, and the Commission supported that conclusion with additional discussion. In its RRR, Public Service requests that the Commission adopt a year-end test year methodology to reflect investments that are fully in service at the time the rates are placed into effect. The company argues that the only basis provided by staff and UCA for the adoption of the 13-month average is that the Commission has consistently authorized a 13-month average method. Public Service states that it instead had demonstrated in this proceeding that the Commission has been deploying year-end methods for roughly 40 years. The company further argues that the degree of regulatory lag in the previous rate case is nearly identical to the degree of lag that is occurring in this case. And likewise, the company identifies similar level of earnings attrition in both cases, and neither the matching principle nor arguments about lumpiness of investments are applicable here. Public Service goes on to state if the Commission is disinclined to use a year-end rate base, the Commission could instead implement a prorated year-end rate base that would reflect investments placed in service through the end of 2023, but with a weighted average of the revenue requirement difference between year-end and 13-month average rate base to reflect a September 2023 rather than mid-year average. So the decision point here is, should the Commission adopt a year-end valuation for the test year rate base or instead adopt a prorated year-end rate base discussed at hearing?
I'd welcome a recommendation on this one, Mr. Davis, if you're so inclined, or not, we can.
Sure. Well, I think the Commission should deny Public Service's RRR on this point. As explained in the final rates decision, the Commission rendered findings in consideration of an overall final determination of what constitutes just and reasonable rates. And the Commission adopted the 13-month average approach for valuing the test year rate base as one of the many interrelated determinations regarding the components of the cost of service study. The use of the 13-month average results in overall just and reasonable rates.
Commissioner Plant,
Right,
anywhere you'd like to go.
No, I agree with the recommendation. I ended up in the same spot.
Commissioner Gilman.
I also agree.
As do I, and I just would say a little more. I think these issues are broader and more long-lasting than just those associated with the clean energy transition and go to fundamental long-term rate impacts. In its RRR, the company points out that total gas sales increased in every category for a total average growth rate of 0.7% between 2017 and 22. Based on hearing exhibit 169 and oral testimony from the company's capital spending increased by a compound annual growth rate of 7% from 2017 to 2023, roughly 10 times faster. And from 2020 to 2023, the compound growth rate was 9.3%, and over the last 2 years, 12%. As such, I believe this record shows that there's been a mismatch between the growth in capital spending and the growth of revenues, off by a factor of 10, going all the way back to 2017. For me, the incentive for management to streamline operations and reduce costs that regulatory lag creates is one way to help encourage the company to more tightly manage these costs in the future. I just don't think we can keep going with a business as usual approach, as the long-term rate impacts are going to get increasingly more challenged to manage the longer we wait to bring spending and revenues closer together. So I just throw that out there as the basis of my decision. I don't know if that needs to be in the final order, Mr. Davis, but Um, I throw that out there as being important to my view, and I don't know, Commissioners Plan or Gilman, anything you want to say to that?
No.
All right, Commissioner Gilman. Nope.
No, I'm fine if that ends up in the order. I think the concept of spending discipline, especially under the potential and already, slow sales growth and the potential for flat or declining sales growth in the future is particularly troubling and something that we're extremely focused on. So I agree with your sentiment.
All right, Mr. Davis, if you want to keep going.
Sure. So now we're going to turn to the elements of the rate base that were raised in the RRR pleadings. And recall that the Commission denied staff's request to exclude the Questor Supply Project from the calculation of the target revenue requirement. The Commission agreed with Public Service that the rule that may have required the company to secure a CPCN for the project is not applicable in this instance, primarily due to the timing of the project's construction. And the Commission was also left unpersuaded by staff's argument that further review of the project was necessary. Instead, the Commission found that Public Service had satisfied its burden to show that the project is permitted to be included in the revenue requirement. Also, in paragraph 217 of the decision, the Commission stated that for clarity, all requests raised by intervening party through written testimony or SOPs that are directed at the calculation of the test year revenue requirement but not addressed by the decision are denied. Staff argues in its RRR that the Commission overlooked providing an explicit ruling on staff's recommendation to require the company to participate in a joint study on the broader long-term plans for the rifle processing plant. And according to staff, if the Commission intended for the term review in paragraph 58 of the decision to be more encompassing, this portion of the decision lacks clarity regarding staff's recommendation for a joint study. I recommend here that the Commission deny staff's request to direct Public Service to complete that joint study. In my view, staff fails to justify the need for the study and only speculates that the project could affect the rifle processing plant in unknown ways. Public Service fully owns and operates the Questar Supply Project, the cost of which is at issue in this case because it will be part of the test year rate base. And I think the company has sufficiently justified the need for the project to address current supply constraints in that part of the system.
Commissioner Plant.
I agree with the recommendation.
Commissioner Gilman.
I also agree.
As do I.
In the final rates decision, the Commission agreed with Public Service that the private LTE project meets the definitional requirements of plant held for future use for the purpose of establishing the revenue requirement in this case. The Commission stated that it was satisfied that the project will be used in the future as described by the company, again agreeing with Public Service that it's reasonable for the company to develop its own network because this private network will benefit resiliency and security of its SCADA system, and it will become the primary system once it's deployed. The addition of the devices on this network will also reduce the costs of what is now being provided by a third-party network. Commission went on to express frustration, however, by the absence of key information about any potential future costs associated with the project and the cost share between the gas and the electric operating companies. The Commission stated that additional costs that appear in the future may cause concern and could alter the Commission's view of the appropriateness of the investments. So in its RRR, UCA argues that the record in this proceeding supports the removal of $3.5 million from rate base that is associated with this project. UCA repeats its allegations that the project is actually intended for electric service, and also it raises its allegations that the project is not used and useful. UCA also questions the need for the project and its inclusion in rate base while customers are still paying the third-party telecom companies for the services they are providing, but as a backup. UCA further argues that although the project may meet definitional requirements for plant held for future use, that kind of accounting does not govern a regulator's treatment for rate-making purposes. The UCA goes on to fault the Commission for not presenting an analysis of its authority with respect to the recoverability of costs in a rate case. So the decision point here is, should the Commission reverse its decision to allow public service to include the costs of the private LTE project in its rate base held as plant for future use?
Do you have a recommendation?
Sure. I think the Commission should deny UCA's request. The Commission fully considered the arguments that UCA is repeating in its RRR. The Commission properly concluded that the project qualifies as plant held for future use for the purpose of rate making, and UCA has not sufficiently refuted that the project will not be used for the company's gas operations, as Public Service has explained. Public Service has further sufficiently supported the need for the project for its operations of the gas utility. However, UCA is correct that the rates decision could be modified to properly identify which system will serve as the backup. Advisors agree with UCA that it will be the third-party system that will serve as backup after this private LTE project is operational.
Commissioner Plant,
I agree with the recommendation.
Commissioner Goman.
You know, I find myself agreeing with UCA on this point. You know, much of the argument that I recall within the hearing was really around the accounting treatment of the asset and how that should be treated. But I think we perhaps glossed over too much the key question of if the company had carried their burden to show that this investment intended to be useful in future years is prudent. And while I understand that it appears in this request was for PSCo's gas portion for the acquisition of rights to the wireless spectrum, I find far more unanswered questions than things that we know about how this will be used and what it will cost. Witnesses were unable to identify the total costs associated with the project, total timing, making it difficult to identify the appropriateness of the cost allocation, first of all, to the gas system itself, but also to understand the actual prudency of the investment in total once all of its stages are complete. Chairman, I think you've pointed out in the past that prudency may depend, or the need for a project may depend on the cost of the project, and something that may be necessary at one cost may not be necessary at another cost. And so while, you know, I'm not going to squabble about the accounting treatment of something that's not used yet but will be used in the future, what I question is, without knowing the total cost of this project as it's implemented, or seeing a detailed analysis or understanding the cost to maintain the third-party networks as backup, it's very difficult to understand if this is in total over the years it will transpire and what we're kind of beginning to sign up for here, a prudent investment. It may well be. I just don't think we have in this record enough information to make that determination and place into rates a portion of the project for which we don't understand the totality of the project and therefore its prudency.
So your argument, and I may need to, I may have the same request you have, which is to bring it back tomorrow. But so basically your argument is it's just premature to put this into rates now until we can see the big picture. Not that it's imprudent, it's just sort of premature.
They have not yet met their burden to show the prudency of the investment because we actually don't understand what that investment may or is planned to turn out to be.
All right. If we could take this one up tomorrow, hopefully we don't have too many like that, but I wouldn't mind an opportunity to just dig into it a little more, if that's okay with you, Commissioner Goman. Commissioner Plant, any comments on this? I guess you guys could help out me, but I'd like to read a little more.
Yeah, no, I appreciate the opportunity to take another look at it. And if I understand, Commissioner Gilman, your position is to take out all the costs or take out partial costs, or would you support UCA's motion to take out all the costs associated with the project?
Yeah, I don't see them as having met their burden to place any of the costs into rate base with the record that we have in this proceeding and all of the things we don't know and don't understand about the costs of the projects moving forward.
Okay.
We're fixed rate, Mr. Davis.
Okay. Well, let's leave rate base then and move on to expenses. In the final rates decision, the company disallowed the costs associated with vacant positions from being included in the calculation of the base rate revenue requirement. The commission agreed with staff that shareholders should not enjoy all of the benefits from the company's efforts to cull its payroll. The commission also concluded that it is reasonable to expect the company to determine whether certain vacant positions should be reflected in the cost of service based on expected business needs, rather than to rely on a flawed blanket assumption that previously filled positions will continue to be necessary. The commission directed Public Service to remove from the revenue requirement the full annual compensation, and this is important, assigned to the company for the 207 position opened from involuntary terminations and the 419 positions opened from the acceptance of a voluntary retirement package. Public Service challenges the Commission's directive to remove these costs from the test year cost of service. The company's primary request here is for the Commission to reverse itself and to have the revenue requirement based on the labor costs the company actually incurred in the 2023 test year. Public Service points to an analysis in its rebuttal testimony showing gas jurisdiction labor expenses to be higher in the first 6 months of 2024 than in any other prior 6-month period going back to January of 2022. Public Service likewise states that a significant portion of the positions that have since been backfilled, and that a significant portion has been backfilled, and that beyond headcount, labor costs also reflect salary and base pay amounts, benefits, and taxes, which are affected by the individuals in the positions and the changes in their job duties. Public Service further points to its rebuttal testimony to explain that only one of the 419 voluntary retirement program departures was a Public Service gas employee, and only 4 were gas employees at the services company. The company further states that of the 207 involuntary terminations, 90 were part of the normal course of business performance reviews, and dismissal was because of poor performance, such that the remaining 117 were the result of the reorganization programs. If the Commission doesn't reverse itself on RRR, Public Service requests that the Commission modify the required adjustments in 2 ways. First, the disallowance should reflect only the number of open positions that were not backfilled, which would be 323 instead of 626. That would mean a reduction of $2.3 million to the target revenue requirement as opposed to $4.6 million. And second, that the test year cost of service include $4.9 million of costs that were associated with implementing the reorganization. Public Service states that these adjustments could increase the base rate target revenue requirement as a whole, unlike its primary request to use the labor costs the company actually incurred in the 2023 test year. So the decision point here is, should the Commission reverse itself and allow the revenue requirement target to be based on the labor costs the company actually incurred in 2023?
Do you have a recommendation?
I do.
Yep. Give us
Okay.
your recommendation.
I'd suggest that the Commission deny Public Service's RRR on this point. The Commission did not require Public Service to remove from the cost of service all costs associated with the positions made vacant across Xcel Energy system from these programs. It was clear from staff's answer testimony and public services rebuttal that the 207 positions open from involuntary terminations and the 419 positions open from the acceptance of the voluntary retirements were corporate-wide figures. So the final rates decision specifies that the revenue requirement for the gas operations for Public Service Company of Colorado should include the costs of the vacant positions assigned to the company. This directive is not unreasonable and should have been anticipated by the company as a potential outcome of the litigation over this issue in this proceeding.
Commissioner Plant,
I agree with the recommendation.
Commissioner Gilman,
I also agree.
as do I.
Okay, now we'll turn to executive compensation. In its R, UCA argues that the Commission fails to state any findings or conclusions with respect to UCA's executive compensation recommended disallowance, which is premised in part on the application of the Drucker compensation principle. UCA faults the decision for not discussing executive compensation outside of the investor relations expense context and requests reconsideration of UCA's proposed disallowance of executive compensation expenses, and UCA asks for a specific statement of findings and conclusions on what it calls a $1.6 million issue. So the question before the Commission is whether to disallow $1.6 million from the revenue requirement as requested by UCA.
And do you have a recommendation?
Sure, I can make one. I recommend not relying on the Drucker compensation principle as the basis for disallowing any portion of the executive compensation. The company provided what I see as credible evidence in its rebuttal testimony that this principle is not currently recognized by industry as a relevant metric for executive compensation. Also, UCA itself characterizes the proposed $1.6 million disallowance as, quote, a rough estimate because it did not have detailed compensation data. Furthermore, the weight of the evidence leans towards rejecting the principle as not shown to be applicable to the utilities management today. So the principle alone, we think, is insufficient to require the company to disallow or for the Commission to disallow a $1.6 million amount associated with the principle alone. On a going forward basis, however, the Commission could continue to examine just how much of executive compensation should be included in rates. Expenses in the cost of service model need to be both prudent and reasonable and necessary for providing the service. This is an issue the Commission may want to further develop in another rate case to build support for disallowing some portion as related to shareholder interests or other interests, but the record here, a rough estimate is not sufficient to do that.
Commissioner Plant?
Thank you, Mr. Chair. I agree with the recommendation, not necessarily the entire basis of the recommendation, but unfortunately, I don't think a sufficient record was developed in this case, and I still don't know what level of compensation falls on stakeholders versus the ratepayers. And my understanding is that much of the compensation, the executive compensation that is over the Drucker principle is through stock options, which may appropriately fall on shareholders and not on ratepayers. But we have no record in this case in terms of what that impact is. I don't agree with the foundation of Xcel's opposition to the Drucker principle. I think their complete disregard for the use of the principle probably has less to do with an objective analysis and more to do with self-interest. But I also don't think that the advocates presented sufficient evidence to support using the principle. All in all, I think the proposal wasn't given enough consideration to develop a sufficient record. I will say, I think we need a standard in the future regarding what the level of compensation is reasonable to attribute to ratepayers. It seems to me crazy that the company can seemingly pay anything for executive compensation and expect that ratepayers are going to pick up the tab. I'm disappointed that we didn't establish a sufficient record in this case to adopt one, but I do think that that's something that we need to address in future cases.
And do your comments give us a sufficient basis to set the next case up? Or is there more you'd like to see in this order?
Well, I think, I don't know if it gives us, does it give us the sufficient basis? I don't know. I mean, at the end of the day, I feel like we don't have enough information about what portion of an executive compensation falls on shareholders and what falls on ratepayers, or what's being proposed to fall on shareholders and what's being proposed to fall on ratepayers. And the Drucker principle is one mechanism for establishing that. If we don't use that, what is the appropriate mechanism to use so that we can appropriately allocate those costs? I think that shareholders make determinations on executive compensation. Certainly, a number of the responsibilities of the executive employees is to serve the shareholders directly. And we don't have a division or a basis for that division, absent something like the Drucker principle. And so in the next rate case, I think it would be appropriate for interveners to come forward and the company to come forward with a proposal of how that should be addressed within the rate making process by the commission.
Commissioner Gill?
Yeah, thanks, Commissioner Plant. I agree with your sentiments and the goal to try and get this developed more in the future. I'm hoping through some of the compliance with Senate Bill 291 that we established in the original decision, looking at actually reporting on time and portion of compensation spent, especially on prohibited activities like investor relations and lobbying. We'll get some more clarity and some portion of those that is shown to be by Senate Bill 291 to need to be removed from rates anyway. But I mean, perhaps you had brought up like stock options. We could certainly stand to get more clarity about how executive compensation is comprised, which tends to not really be in those records. That's probably something we could look at in the next rate case, kind of ordering and getting to get more insight. So I think we'll just have to consider between now and then, how do we get more insight in order to really understand in the record in the next, and knowing that we will have ideally considerably more information, especially as it relates to the prohibited expenses from Senate Bill 291 and how that might impact executive compensation as well. But I agree with the recommendation. Sorry.
Yeah, as do I. And I'd like to see some language in this order, trying to frame up Commissioner Plant's concerns for the next rate case as best we can in this order, including some informational requests. So with that, Mr. Davis, do you want to frame up the next issue?
Sure. The commission explains in the final rates decision that it was unpersuaded by UCA's arguments in favor of a disallowance of the costs of liquefied natural gas, and instead concluded that public service had satisfied its burden to support the inclusion of third-party vendor support and materials and labor expenses of approximately $370,000 for compressed natural gas and approximately $5.4 million for LNG in the 2023 test year revenue requirement. The commission nevertheless went on to state that it shared many of UCA's concerns about the project in Breckenridge. Specifically, the commission noted that the company did not appear to have identified the capacity need much before it became a major shortfall, which potentially limited the options and increased the price of a remedy, nor did the company appear to undertake preemptive actions to potentially avoid the $5.4 million per year expense. UCA argues in its RRR that the LNG represents an imprudently purchased and overly expensive insurance policy to address potential design day conditions in Breckenridge, but have gone so far unused. UCA concludes that the Commission's concerns about LNG support an opposite result than what was implemented in the final rates decision. Or in other words, the Commission's stated concerns and the record support UCA's RRR request to deny Public Service's request for recovery of its third-party LNG costs of approximately $5.2 million. So the decision point for you is, should the Commission disallow $5.2 million of LNG deployment expenses from the base rate revenue requirement as requested by UCA?
Maybe I'll start with you on this one, Commissioner Gomez. I think you were digging into this at hearing, and I think I'm curious to know what you think before I open my mouth. So,
well, sorry to complicate your lives more before tomorrow morning, but this is another point where I find many of the arguments in UCA's RRR on this point persuasive, and feel strongly we should reconsider this issue by granting the RRR in part and finding the company did not meet its burden to show that at least the $5.2 million in LNG expense was prudent, and as such did not adequately support its inclusion in the 2023 test year revenue requirement. I'll go through a few of the reasons why I think this is the most reasonable outcome. There are a few, so bear with me. First, I think it's clear that in the company's testimony, while there was a cost incurred for 2 winter seasons, the company has ceased to contract for LNG service in Breckenridge, instead opting to purchase its own equipment for this purpose. As such, it's clear on this record that the O&M expense the company is intending to include in the modeled test year will not be reflective of O&M expenses for LNG in this particular application for the going forward years. While Mr. Bouquet asserts the company is adamant the O&M costs will still be higher, there was no evidence provided to support that claim, and the record demonstrates that this particular expense will not continue in its current form after the test year. Second, UCA raises that the record demonstrates poor system planning and analysis by the company. On this point, I find very persuasive, as there's significant record evidence to support looking at this issue more broadly, to understand the idea of prudency in a broader sense and understand how we got to this point, and if the planning and actions that were taken or not taken by the company really amount to a prudent process and a fair end result for ratepayers. In this regard, the record leaves more questions than answers in how we got here. How we got to a capacity shortfall that required 8 LNG tankers to fill in a town of not even 5,000 residents is an astounding shortfall and planning failure that we're now being asked to help solve. What we do know on this record is, while the commission was generally in agreement in a separate proceeding, the LNG or CNG could be part of a non-pipeline alternative. That's not necessarily what went on here. This deployment was not part of any approved or planned NPA, nor does it appear on this record to have been conceived in 2022 to be part of any more strategic action. Rather, it looks to be a result of the company undertaking a process whereby the company hooked up more customers than it knew or should have reasonably known the system could reliably serve. And then we faced a crisis situation that has taken millions of dollars to solve. And in this case, the shortfall the company is planning for is a very significant shortfall in a relatively remote, low-density portion of their system. And it's hard to understand why there was not more foresight or planning. The company presents an incomplete and at times conflicting picture of when the company knew and began planning for capacity issue in the area. On the one hand, it was characterized in the hearing as a need only identified before the 22-23 heating season, but another witness described the company was aware of a capacity issue in the area for quite a while and had been studying the issue for a few years. The company was not able to say if the capacity shortfall has been observed to be growing or shrinking, which I would imagine prudent planning would be keeping close tabs on. They were also unable to say what growth assumptions were used to support the calculations of the size of the shortfall and the LNG expense. The actual geographic area that's a subject of concern was also not able to be described, making it difficult for us to get a handle on the actual geographic constraint at issue here. Certainly there are some obligation to serve issues that may come up here, but I think it's important in consideration of obligation to serve to understand that this does not mean a blank check, and ratepayers have no obligation to compensate utility management and shareholders for imprudent decisions and behaviors. A core function of the commission is to protect ratepayers who have no alternative but to take service from the territorial utility by scrutinizing utility investments to ensure they're prudently incurred. This is a critical check on the utility management decisions, and we hold the utility responsible for making all reasonable efforts to gather relevant information and respond appropriately. Claiming the utility had to make these investments to fulfill its obligation to serve is not enough in this case, as the utility has to demonstrate prudency, and I don't believe that they have in this case. I find it compelling that public service did not rebut the legitimate questions raised by the commission and interveners that it had failed to properly manage and plan its system to avoid being in this costly crisis situation at the precipice of the 22-23 winter season, and yet again the next heating season with apparently no intervening mitigation. And this gets to UCA's additional claim, which I also see merit in, that the company has failed to demonstrate it that it adequately explored less costly alternatives. Primarily here, UCA focuses on CNG, but I think it's important to understand that other alternatives could have included other measures. I will note that Public Service Company ran a gas demand response pilot in Summit County, yet had no reference or information as to that program, which clearly could have potentially been used in this circumstance, knowing there was a crisis situation in terms of a capacity shortfall in the area, nor did they were they able to communicate to us that they pursued any efficiency, beneficial electrification, or moratoriums aimed at the area in order to avoid such a significant expense in the area. So I think we also, UCA also raised legitimate questions about whether it was necessary, since the company did not discharge the LNG within the 2 years that it was located there, except to move the tanker at the end of the season. So the company is clear that gas was never discharged in order to serve a system need. And while it's possible that the system just didn't hit its minimum design temperature in this 2-year sample, it's striking that such an astounding shortfall, which requires 8 LNG tankers or the equivalent of 19 CNG tube trailers, not a drop of that gas was needed into winter seasons, which certainly raises some legitimate questions, as UCA pointed out on this record, about the accuracy and appropriateness of the calculations buttressing the need, given that that calculated need was so massive and no gas at all was actually demonstrated to be needed to fill a shortfall in the area. So be happy to discuss or have you consider those points with regard to granting in part UCA's.
Just one question for Mr. Davis, and then maybe a question for you. This is all expenses, right? So there's no profit to the company. This is not a rate-based thing. This is an expense thing. Is that right, Mr. Davis?
That's correct. That's correct. The cost has been presented to the commission as an expense. It's services that are provided by a third party. There's no infrastructure investment associated with the figures that we've been talking about.
And I guess Commissioner Gilman, are you suggesting denying the whole thing, disallowing the whole expenses somehow imprudent? Is that your request?
There's probably shades of gray here between imprudent and not having proved it was prudent, and I would go with the second. I don't think they've met their burden that this was a prudent expense. And certainly have indicated it's an expense that will not continue past the test year.
So what's your
purchased their own equipment?
So what's your recommendation to us? 0, 5.1 million, 5 million? You asking us to deem the whole thing imprudent? What's the exact request to us?
Yeah, I would deem I would determine that they have not met their burden to show that the $5.2 million in LNG deployment was prudent to be included in the revenue requirement.
We can talk about this more tomorrow, but geez, I'm not there. I mean, I think there were all kinds of it just raises so many issues that we're struggling with everywhere else, subsidizing new growth, non-pipeline alternatives, just how we deal with this transition. It seems too harsh and inconsistent with our prior practice to somehow deem this imprudent now, even though I would agree with you. There's all kinds of planning busts, but I'm not sure what we should have done different or what they would have done different. I mean, would you have not hooked up all those customers? Maybe. I don't know. I'm struggling with this, and I would not be prepared to deem these expenses imprudent, especially on triple R. I just think it's I'm just not there. Commissioner Plant, what are you thinking?
Well, I'd and make a decision tomorrow. But Commissioner Gilman, I think you said near the end that you would partially grant UCA's triple R, and I was wondering what part are you proposing to grant and what part are you proposing not to grant?
I think the parsing here is not determining that the expense is imprudent, but merely that they have not met their burden to show that it's prudent.
Okay.
I got to talk to counsel. I would not frame it that way. It's not how counsel has been defining prudency that way. But all right, we're struggling, Mr. Davis. We're on 10 out of 30, and we've only resolved 7 issues. So if you can help us move maybe a little quicker, that'd be great.
Okay. Well, let's move on to the Senate Bill 23-291 expenses. Senate Bill 23-291 took effect in August of 2023, and it states that a utility shall not recover certain costs from its customers, whether as part of proposed base rate costs, a rider, or other charges. And one category of the costs prohibited from base rates is investor relations expenses. In the final rates decision, the Commission agreed with UCA that the prohibition in 291 is unambiguous and concluded that there's no uncertainty regarding what is considered investor relations expenses within the scope of the investor relation expenses raised and presented in previous rate cases. The Commission determined that Public Service needed to remove from its revenue requirement calculations all investor relations expenses accounted for in the test year. The commission further determined that a portion of the base pay and other compensation that may correspond to time spent raising capital and performing other aspects of investor relations need to be examined as well. So the commission directed the company in future cases to provide a full accounting of the time spent by company employees, including its executives, in raising capital and in other aspects of investor relations. The commission stated that such increased transparency of employee time will better enable the commission to verify the exclusion of investor relations expenses from base rates in accordance with the new statute. In its RRR, the company asked the commission to reconsider its decision to exclude from the revenue requirement securities filing and related expenses as being prohibited. Public Service repeats its arguments that the statute does not define investor relations expenses, and it also does not include the word all. The company alleges that without explanation, the commission simply adopted the UCA's position without identifying what specific types of investor relations costs fit the statutory language. The company also repeats its argument raised in the case that simply removing whatever costs are included in a particular cost center is inconsistent with how investor relations expenses have been treated historically. The company concludes that the final rates decision disallowed costs that are unquestionably necessary for the company to provide utility service. So on this point, I recommend that the commission deny the RRR. The implementation of the new statutory prohibition on the recovery of investor relations expenses is being made in this proceeding prior to the conclusion of the ongoing rate making. And the decision to eliminate from the revenue requirement calculation all costs that are accounted for as investor relations expenses is consistent with the statute and with the record in this case. Public Service rested its case, assuming that the costs it had identified as investor relations expenses satisfy the provisions in the statute. But the commission concluded that there's insufficient transparency and that there was insufficient record to identify any type of investor relations costs that may not fit the statutory language. So the commission correctly directed the company to remove from its revenue requirement all investor relations expenses in the 2023 test year. In addition, the company's arguments that the excluded expenses are a legitimate cost of providing utility service and therefore must be included is a separate issue, and that is whether the statute itself overreaches. And to the extent the company has a claim that the statute overreaches, Public Service has not sufficiently raised this claim in this proceeding.
Commissioner Plant,
I would agree with denying the RRR.
Commissioner Goodman,
I also agree.
as would I.
Now, UCA in its RRR explains that it argued against the inclusion of some $142,000 of investor relations expenses. And according to UCA, Public Service in its rebuttal testimony added that amount back into its cost of service study, stating that during its review of the exclusions, it determined that certain expenses that were necessary to comply with legal requirements or that were otherwise necessary for public capital markets had been inadvertently excluded. UCA requests that Public Service demonstrate that that $142,000 was removed from the revenue requirement calculation. And on this point, I recommend that the commission grant UCA's request in part. If the final decision that's reached tomorrow requires Public Service to adjust its base rates, the commission should direct Public Service to include in its compliance tariff filing the updated cost of service study in an executable format and to serve that executable copy on the intervening parties in this case. But if the decision does not require Public Service to further adjust the base rates that took effect in November, the commission should nonetheless direct the company to file in proceeding number 24AL-0049G the cost of service study updated in accordance with the final rates decision. The filing should be, again, in executable format.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
So I'm going to turn it over to Commission Counsel to present the next two decision points.
Ms. Harper,
First, commissioners, a bit of background. SB 23-291 also prohibits from recovering in customer rates expenses for lobbying or other activities meant to influence the outcome of any local, state, or federal legislation, ordinance, resolution, or ballot measure. The term lobbying is, as used in this provision, is defined in statute as directly or through the solicitation of others, communicating with a person that is in a position to make a policy decision in order to influence the outcome of local, state, or federal legislation. In your decision, the commission expressed concern that public service may not be accounting for these expenses of employee time by non-registered lobbyist employees who nonetheless engage in directly lobbying, solicitation of others, or other activities within the meaning of this statutory prohibition. In response in the decision, the commission directed public service to take 3 actions. First, file an update to its 2023 annual report showing the portion of total compensation of Excel employees that corresponds to their time spent on lobbying after the effective date of the legislation. 2, track and report the portion of total compensation for 2024 and through the next rate case for any employees who engage in lobbying, and track these internal employee lobbying expenses in a regulatory account starting January 1st for review in the company's next base rate case. So turning to the 2 decision points that I'll present on this issue. So the first issue, public service asks in its RRR that the commission reconsider these 3 requirements. The company argues that only communications with legislators specifically to influence legislation constitute lobbying for which cost recovery is disallowed. It contends the commission expands the definition of lobbying beyond the letter and spirit of the law, and that the commission's application of the legislation would potentially cover a host of activities by non-lobbyist employees that don't fall within the statutory prohibition. They also raised that the cost of tracking and reporting time could substantially and potentially outweigh any direct savings to customers. So I can pause here for questions or proceed to a recommendation on this first issue.
now if you can give us your recommendation, that'd be great.
So I recommend granting the RRR in very limited part to clarify these directives so that the company can better understand what you are requiring of them. To that end, I recommend that you clarify that public service is required to track and report the portion of total compensation for calendar year 2024 and each calendar year through the next rate case for the time spent by any employee who first engages in lobbying pursuant to the company's interpretation of the prohibited expenses for lobbying and other activities. And second, to track the time spent for any employees who engage in lobbying pursuant to the commission's potential broader reading of the statute, which would include upstream employee time spent in engaging with registered lobbyists. The intent here would be to capture employee time under the other activities portion of the statute, as well as through the solicitation of others portion of the statute. And the commission could then use these reports in the next proceeding to determine whether these additional time should be excluded from base rates or take other appropriate action.
Commissioner Plant,
Yeah, I agree with the recommendation. I do have to point out, I mean, I think that the company is kind of parsing words here, and the the point I think that the legislature is getting to is that the time that is spent by a utility employee on lobbying issues is time that is not spent on utility service, which is what we're, instructed to allocate to the ratepayers, not time spent on lobbying. So I maintain that our approach is consistent with the legislation and consistent with the legislative intent. However, I would support the council's recommendation to break out those costs for future consideration in the next rate case.
Commissioner Gutman.
Yeah, I am kind of with you, Commissioner Plan. I'm a little confused by the company's arguments here. That, it's only lobbying if we're talking about a registered lobbyist talking directly to a legislator. It doesn't take an interpretation. You just have to pull out the actual language from the statute to understand that it is broader than that. So perhaps just like a slight modification or twist, Ms. Harper, to your recommendation. There are at least 3 kind of categories I can see indicated by the language in the statute. So I guess conceivably the company could track separately the cost of each effective portion of the statutory language, which could include direct lobbying through registered lobbyists to influence policy outcomes, any expense incurred in relationship to lobbying through solicitation of others to influence policy outcomes, and the bucket of other activities meant to influence the outcome of any local, state, or federal legislation, ordinance, resolution, or ballot measure. I guess they could separate in those 3. I'm not sure I see room for some different language that's not in the statute, but so long as they track those 3 and are able to present those in a rate case, if they want to track it some other way and show that too, I guess they can be free to do so. And then clearly, to the extent employee compensation is an expense, it should be tracked as an expense as it falls into one of those other categories. Hopefully that's clear, but to the extent we end up with kind of multiple categories to better understand where the expenses are actually falling with regard to all of those different operable provisions of the statute, that's great. That's more transparency, and I would support having that to consider in future rate cases.
I don't disagree with anything said by my colleagues. Does that give you what you need, Ms. Harper, to draft the decision?
Yes, it does.
All right, let's keep going.
One more decision point on this issue. In its RRR, Public Service alleges that the requirement in your decision for the company to update its 2023 prohibited expenses report and to begin tracking costs from January 1st, 2024 could constitute retroactive rate making. Public Service maintains that until the commission issued its decision, it had no notice that it would be required to track and report non-lobbyist employee compensation for rate making purposes, that alleges it wasn't required to under the statute, and it was not able to expand its tracking in that manner. As a result, Public Service asked the commission to confirm that it is only required to track time for employees to engage in lobbying, beginning with the effective date of rates in this case, which would be November 5th, 2024. Pause here for discussions or give my recommendation.
Yeah, why don't you give your recommendation?
So I recommend granting the RRR in part and ordering that Public Service must track all potential compensation as of November 5th, 2024. Although frustrating, this responds to the practical considerations that were raised by Public Service in its RRR.
Commissioner Plant?
I'm a little disturbed by this one. I mean, it seems like their default is their interpretation, which is a pretty narrow interpretation of the law, and that they're, you know, only going to apply it now to 2 months out of this year because of that interpretation. And I'm wondering, is there an opportunity for, you know, in the next rate case for them to take their annual costs and apply it to 2024, or annualize the costs that they track in November and December and apply that to 2024 in recognition of the fact that they haven't tracked it for the first part of the year. I don't know what you guys think about that. I mean, an annualization of, you know, taking 2 months and annualizing it would probably give us a little more. Well, I don't know if it would give us a little more accurate, since the legislature's in session from January to May. So I don't know that even gives us a very good view on it, or if we take future years and apply it to 2024. I'm not sure what's the best approach here. I don't know if you guys have thoughts on that.
Commissioner Goman?
I don't have any brilliant thoughts on it. I mean, this is kind of just a mess, given where we are. Fairly surprised that they needed us to explain the words in the statute to track it more appropriately, given that the statute's already in effect and says you may not request and you may not put into rates these expenses, which I think is pretty clear. But given where we are in the process, I don't see a lot of clear options, except to really have better information and consider this in the next rate case, with the more accurate tracking that we discussed in the previous point. So I'm not clear on like a satisfying path forward with regard to this. I mean, clearly in a more optimal situation, they would have been reading the words in the statute and interpreting it, and tracking that time from the effective date of the statute, which I think would be the expectation of the legislators. But that's not what happened, apparently. So it seems to me the best we can do is go forward and look at it in the next rate case, and have that time be tracked as we indicated moving forward. But curious if there's any other good ideas.
I don't have anything else. Would that work for you, Commissioner Plant?
Yeah, I mean, it's less than ideal, clearly.
That describes my day.
I'm not sure. I'm not sure what our best options are. So,
all right, Ms. Harper, you want to keep going?
We'll be turning it back over to Mr. Davis now.
Right. So UCA requests in its RRR that the commission clarify whether any adjustments related to lobbying are required to the revenue requirement calculation used to establish rates in this proceeding. And here I recommend that the commission not order on RRR that Public Service adjust its base rates to ensure that no prohibited lobbying expenses are included in the calculation of the underlying revenue requirement. The provisions in the final rates decisions recognize that in this proceeding, Public Service may have in fact unlawfully proposed to include prohibited lobbying expenses in the base rates. However, as Public Service states in its RRR, the company has not begun to track and report non-lobbyist employee compensation for rate-making purposes. So it's not possible, I think, for the Commission to require an adjustment as UCA contemplates in its RRR. Instead, the reporting requirements in paragraph 171 of the decision are intended to provide information that could be relied upon by parties, such as UCA, in seeking the relief provided in the statute itself pursuant to section 40-3 114.4. So again, I recommend that the commission not order on RRR that the company must now adjust the base rates that took effect in November to account for these lobbying expenses that you've just been discussing with Commission Counsel.
Commissioner Plant?
yeah, once again, less than ideal, but I'm not sure what what our alternative is. So I support the recommendation.
Commissioner Gilman,
I agree.
as do I.
Okay, so one more Senate Bill 291 related topic, and that's rate case expenses. The commission provided direction, or the commission noted that the General Assembly has provided direction to the commission to examine rate case expenses with more scrutiny. The decision further states that the intent of the new statute is clear and that the amount of rate case expenses that a utility may recover from ratepayers may be limited. The final rates decision states that in consideration of the record specific to this case, the company would be authorized to recover an amount not to exceed the total estimated costs put forward in rebuttal testimony, less $130,000, which is an amount equal to 1/2 of the $260,000 incurred for the 2 outside consultants used by the company. And remember, paragraph 217 of the decision denied all intervener requests not addressed by the decision. In its RRR, UCA argues that a further reduction in recoverable rate case expenses are warranted. First, it renews its request for a disallowance of 50% of the outside legal costs. Second, it argues that the record in this case supports further reducing the recovery of the consulting expenses to 0 because, quote, the veracity, reliability, and merit of the recommendations of each witness were undercut by substantial evidence in the record, and each witness's recommendations were soundly rejected by the commission. And third, UCA asked the commission to render specific finding disallowing the recovery of some $16,855 of loading expenses. On this point, I suggest the commission deny the RRR and retain the findings and directives related to rate case expenses as set forth in the decision. The decision establishes the rate case expense to be used in the cost of service study in consideration of the specific record in this case. The commission considered the same requests put forward by UCA when authorizing public service to recover the amounts it's allowed in that decision. Also, Section 43-1025 that was enacted by 291 directs the commission to limit the amount of rate case expenses through rules. But in this case, this is going to be a decision prior to the enactment of such rules, and the commission has thus limited rate case expenses based upon its full consideration of the evidence offered here.
Commissioner Plant,
I agree with the recommendation.
Commissioner Gilman,
I also agree.
as do I.
So now we're going to turn to some things that were addressed in the case, but may not relate directly to the cost of service study or the rates that took effect. The commission declined in the decision to reverse its recent order setting the carrying cost for gas inventories held in storage. And that cost is set at a short-term debt rate. The commission stated that the appropriate cost was fully examined in the 2022 gas rate case, and the commission agreed with UCA and staff that nothing has changed since that previous case to warrant reconsideration of the commission's determinations. The final rates decision directed Public Service not to modify sheet number 50C of the GCA tariff. This preserved the status quo. The short-term debt rate on sheet number 50C is the monthly interest rate equal to the average of the daily rates for commercial paper. And the tariff says that that return will be adjusted for income taxes before being multiplied to the storage inventory amount. In its RRR, Public Service again asked the commission to reconsider its decision to set the return at WACC instead of the short-term debt costs. The company argues that the decision rendered in the past case is not supported by the record in this case. The company also argues that the commission's finding that the cost is a temporary or short-term cost of an asset is unsupported. The company argues that while the amount of gas storage may fluctuate as gas is injected and withdrawn, the company must still invest capital on an ongoing basis due to the continuing need for gas storage. The company argues that this inventory is a service-producing asset that's entitled to a WACC return. I recommend that the Commission deny Public Services RRR on this point. The Commission fully considered these arguments when rendering its finding in the final rates decision, as well in the previous decision. The Commission correctly concluded that the matter was recently examined and resolved, and nothing has changed in the meantime.
Commissioner Plant.
I agree. Are we going to do all GSIC separately?
Well, I have a point on the tax gross up yet to present, and also a request to remove short-term debt from the capital structure.
Okay, we're doing them separately though.
Yes.
Okay. Yes, I agree.
Commissioner Gilman.
I also agree.
As do I.
So that tax gross up. Public Service asks in its RRR if the Commission affirms that the company's cost of short-term debt will serve as the gas inventory cost. The Commission should specifically address UCA's recommendation to deny a tax gross up. On this, I recommend that the Commission continue to preserve the status quo and to deny Public Services RRR on this point. The final rates decision maintains that the short-term debt rate is defined on sheet number 50C of the company's tariff, and 50C, as I just mentioned, also retains the tax gross up. Notably, neither staff nor UCA filed RRR on the GSIC determinations that the Commission made in the final rates decision, or in other words, neither UCA nor staff objected, at least through a RRR pleading, to the gross up being retained.
Commissioner Plant.
I agree.
Commissioner Gilman.
I also agree.
As do I.
And then the third point here, if the Commission affirms the company's cost of short-term debt will serve as the GSIC, the company wants the Commission to remove the GSIC portion of short-term debt from the calculation of the company's overall WACC, because that short-term debt would no longer be available to finance other assets. I also recommend that the Commission deny this request by maintaining the status quo with sheet number 50C. The Commission did not require Public Service to use the cost of short-term debt established for the determination of WACC to be specifically what is the financing mechanism for the gas inventories. The record in this proceeding does not support the link that Public Service asked the Commission to make between actual uses of short-term debt, and which is included in the capital structure, and the financing of these gas inventories. By maintaining the status quo, the Commission found that for cost recovery purposes, it's appropriate to include a carrying charge for gas inventories based on published commercial paper rates. The Commission issued no findings or directives regarding exactly how Public Service must finance its gas inventory purchases or otherwise spend funds it acquires as short-term debt.
Commissioner Plant.
I agree.
Commissioner Gilman.
I also agree.
As do I.
Before I move on to information technology, I want to make sure I've covered everything that Commissioner Plant was expecting me to cover with respect to these items.
Commissioner Plant.
Yes.
Great. Okay. In its RRR, UCA argues that the final rates decision failed to state any findings or conclusions with respect to the recommendation that the Commission investigate Public Services information technology costs. UCA points to its answer testimony and its SOP where it raised concerns about, quote, ever-increasing magnitude of spending on technology services. UCA requests that the Commission open a separate proceeding to investigate IT costs, either an investigatory proceeding or a miscellaneous proceeding. I recommend that the Commission deny this request. The Commission properly rejected the proposed study by paragraph 217 of the rates decision, and we're not convinced that a rate case fails to offer the parties and the commission sufficient opportunity to review these issues.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
So we're now reaching the final 10 decision points, and I'm going to turn it over to Ms. Akamwa.
You're on mute.
I apologize. Good morning, commissioners. I'm Juliet
Morning.
Akamboy of your advisory staff, and I'm presenting the issues raised by staff on the Quality of Service Plan, QSP. By decision number C-24-778, the Commission approved the continuation of public services existing QSP metrics with the same penalty levels through December 31st, 2026. The first item is the grade 2 leak repair metric. In RRR, staff request the Commission reconsider its decision to maintain the 40-day grade 2 leak repair metric for the company's current gas QSP as proposed by the company. Staff argues that the company's position in its rebuttal testimony, quote, clearly demonstrates its ability and willingness to accomplish stricter grade 2 repair metrics, end of quote, and that adopting a 40-day grade 2 leak repair metric would reduce the duration of harmful leaks on the company's gas system and act to prevent additional methane release into the environment. The decision before you is, should the Commission reconsider its decision not to modify any elements of the company's gas QSP in this proceeding and instead adopt a 40-day grade 2 leak repair metric as requested by staff? I'll pause for discussion or make a recommendation.
You can make a brief recommendation. That'd be great.
Thanks. Advisors recommend the Commission deny staff's RRR on this point. For regulatory efficiency, the Commission should maintain its decision to approve the extension of the current QSP with no modifications. The proposed rulemaking by PHMSA regarding leak detection, repair, maintenance, and reporting, and the Commission's rulemaking in similar ways should be considered when setting an appropriate metric for grade 2 leak repairs. We also believe the consultative stakeholder sessions contemplated in the final rates decision will further generate more thorough discussions and solutions to be incorporated in the next QSP filing.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
The next item is the stakeholder process requirements. Staff requests that the Commission clarify its expectations for process and timing of the required QSP filing to ensure the stakeholder process provides meaningful results. Staff specifically seeks 1, a requirement for at least 4 stakeholder meetings with input in several phases, and 2, specific deadlines for the next QSP filing. The decision before you is, should the Commission set further expectations for stakeholder engagement leading to the future filing for public service addressing its gas operations QSP, such as setting a minimum number of stakeholder meetings, requirements for stakeholder input in phases, and a specific filing date as requested by staff. I'll pause here or make a recommendation.
Yeah, if you can make a recommendation, that'd be great.
Thanks. Advisors recommend that the Commission adopt language in the order addressing RRR in support of a robust stakeholder process for improving the company's gas QSP. While staff has not established why at least 4 stakeholder meetings are necessary, the Commission should advance the notion that there should be multiple opportunities and phases for staff and others to provide input. Advisors also recommend the Commission adopt starting the formal review of a proposed QSP in mid-2025 and requiring a filing deadline of June 1st, 2025.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
Thanks, that'll be all for me. Back to Ron.
Thank you. Mr.
So,
Davis.
The next decision point is on the decoupling that was proposed. The final rates decision declined to approve Public Service's proposed revenue stability mechanism. That was described as the company as a full decoupling mechanism. The commission concluded that the company's own testimony supported the finding that the primary issue with the mechanism is one of rate design, and that this was not a rate design proceeding. And the commission also agreed with UCA's observation that it was necessary to consider how decoupling alters the company's risk profile, and hence the appropriate return on equity to be established by the commission. The commission concluded that the review of decoupling requires the full context of a full combined phase 1 and phase 2 rate case. In its RRR, Public Service argues that the proposal in this case was designed to work within the current rate design and does not constrain any future rate design options. The company also says that delaying a decision on decoupling to a phase 1 and 2 rate case would only delay the benefits of the proposed decoupling at a key time when the company is beginning to implement its first commission-approved clean heat plan. Public Service specifically asked the commission to adopt the proposed decoupling mechanism here because it's premised on total revenues to be established in this rate case and is not dependent on a particular rate design. And the company also states that the adoption of the decoupling proposal now would not preclude any changes to rate design while the decoupling mechanism remains in place. I recommend that the commission deny Public Service's RRR on this point. The commission properly concluded that it's not possible to properly render a decision on the company's proposal in the absence of a simultaneous consideration of potential modifications to class cost allocations and rate design. The final rates decision also established that in combination with potential changes in cost allocation and rate design, it's necessary to consider how decoupling might alter the company's risk profile. These findings and determinations are sufficiently laid out in the final rates decision.
Commissioner Plant,
I agree.
Commissioner Goman,
I also agree.
as do I.
Public Service wants to be able to propose approval of a decoupling mechanism in a standalone phase 2 rate case, arguing that it would be inappropriate for the commission to adjust the company's authorized ROE due to the adoption of decoupling, because when the ROE is established, it's using the returns for proxy peers, and the establishment of a decoupling mechanism for Public Service would make it actually more like 87% of utility operating subsidiaries of natural gas proxy group companies. I recommend that the commission also deny Public Service's request on this point. The final rates decision properly concludes that it is not possible to properly render a decision on decoupling without simultaneous consideration of potential modifications to class cost allocations and rate design, and how those changes might also affect the company's risk profile.
Commissioner Plant,
I agree.
Commissioner Goman,
I also agree.
as do I.
We'll now turn up to the depreciation trust. In the final rates decision, the commission found it necessary to limit ratepayers' exposure to uncertain future asset retirement liabilities and required the company to establish a separate trust to account for the anticipated cost of the removal of infrastructure. The commission specifically directed Public Service to place $15 million per year collected through the depreciation expense as presently calculated, and to move that into a separate trust account. Public Service does not object to the directive to establish the trust, but in its RRR, it seeks approval to maintain a regulatory liability, specifically reflecting the amounts to be invested in the trust, thus providing the company time to develop a proposal for the form and investment strategy of the required trust. Public Service states that it needs time to establish an appropriate trust and to develop that fund investment strategy, arguing that the creation and management of this new type of trust is highly unusual and it's complex. Public Service states that the trust will be a new legal entity and it will be significantly more complex than a relatively simple investment account. Public Service says that the trust will also require an investment policy statement and a legal agreement, as well as specific tax-related planning and goals. Public Service clarifies that the regulatory liability it seeks on RRR will include a WAC return on the initial deposits until the trust is created. And on this point, I recommend the Commission grant the request. The development and implementation of this depreciation trust is a significant new endeavor, and it would be useful for Public Service to have additional time to develop the trust to fully implement the intent of the final rates decision with respect to the net salvage value issue.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
Public Service proposes to bring forth this proposal in its next depreciation study filing, and I recommend that the Commission grant that request. It's reasonable for the company to develop a more detailed proposal and to present it in the already planned depreciation study proceeding.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
The record in this case says that that depreciation study is supposed to come in February of next year. Public Service requests in its RRR an extension of time to file that study, however, to March 31st, 2025. The extension is intended to give it time to address a number of aspects of the final rates decision. And I recommend the Commission grant the request. It's reasonable, and the delay is only about a month.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
And the final rates decision also required Public Service to file a Phase 2 rate case within 9 months of the final order, or more or less July 25th, 2025 would be the deadline. The filing must include the entire set of tariff sheets that comprise the company's line extension policy and any other policy that might dictate cost allocation of new or upgraded facilities needed to serve new or increased load. In its RRR, Public Service asked to be allowed to file the Phase 2 rate case by the end of next year instead of the July deadline. I recommend that the Commission grant that request. The request for additional time is reasonable given the scope of the Commission's filing requirements. It also remains uncertain as to when the SB 291 cost causation study will be complete, and therefore the Commission should not tag or peg the filing deadline to the results of that study.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
Changing subjects once again, in its RRR, USAA states that it would be unable to definitively determine if Public Service correctly implemented the Commission's directives. USAA asked the Commission to direct Public Service to file an explanation of how it calculated and implemented the decisions rendered through the final rates order. As I mentioned earlier, the Commission should grant USAA's request in part if the decision on RRR requires an adjustment to base rates. The Commission should direct Public Service to include in its compliance tariff filing the updated cost of service study in executable format. And if it does not require a change in base rates, the same filing should be made to explain what was used as the basis for the compliance filing.
Commissioner Plant,
I agree.
Commissioner Gilman,
I also agree.
as do I.
And for the final point, in its RRR, USAA faults the Commission for not requiring Public Service to provide those calculations in its compliance tariff filing. USAA argued it's necessary for Public Service to provide those calculations in an executable format so that the Commission and the parties can determine whether the compliance filing properly reflects all ordered adjustments. USAA recommends that a directive to provide such calculations should be made in orders in future rate cases. And although I and other advisors agree with UCA that the review of a final rate calculation is useful for regulatory efficiency, a decision on RRR to a specific decision rendered in a single rate case is not helpful for advancing a general directive. So absent a commission rule, such directives should be made on a case-by-case basis. But I'd also like to note that intervening parties could request that the commission render such directives in their closing statements of position, and they can also propose procedural schedules for the commission's consideration in which the commission has sufficient time to conduct post-deliberations technical conferences and time to require filings of updated revenue requirement and rate calculations, which is often done in rate proceeding when time permits. It's also useful for intervening parties to secure commitments from the company on conferrals and document reviews to foster uncontested compliance tariff filings. All those notions could be included in the RRR decision, but this case is not the right venue for essentially adopting a rule governing compliance tariff filings for base rate cases.
Commissioner Plant.
I do sympathize with UCA on this issue, and I agree that this would be useful. I'll defer to your process observations and agree with the recommendation.
Commissioner Gomez.
I also agree.
As do I. And I think that concludes our list of issues. Mr. Davis, anything else? I have a few comments about how we take this up tomorrow, but any other issues you'd like us to deliberate on?
No, we've finished everything, and we'll be happy to add the case back onto tomorrow's weekly meeting agenda. And that concludes my presentation for today. Thank you.
Stay with us, Mr. Davis. So we'll put this on the agenda for tomorrow, but I'm thinking, given that tomorrow is going to be a 3-hour meeting with all the end of business stuff, I think if you guys, I think we have 3 issues: the cost of debt, the LTE issue, and the LNG issues up in Breckenridge. So I think if you could just be prepared to deliberate, I think we won't have a big have a setup. We'll just jump into the deliberation if that works for the two of you. I see you both nodding, so thank you. And Commissioner Plant, did you have something else before we break?
No, I was just going to clarify what the issues were. So that's
Yes. Yeah, so it's I think it's number 4, the cost of short-term debt, long cost of short and long-term debt, and how we want to match. It's number 7, the private LTE network, and whether that's premature to put in rate base. And then it's item number 10, the liquefied natural gas, and whether that expense is prudent. And I guess Commissioner Gilman, if you could be prepared to lead us off on the cost of long-term debt and short-term debt based on your conversations with counsel and advisors, that'd be great. And I'll be prepared to start us off with my thoughts on LTE and liquefied natural gas, and we'll just use that as the basis for the deliberations.
Sounds fine.
Does that work for you, Commissioner Plant?
Yep, that sounds good.
Anything else, Mr. Davis?
No, thank you. Thank you for clarifying tomorrow's process.
And thank you for getting us through a lot of issues today, Mr. Davis. Greatly appreciate it. With that, see everybody, I guess, this evening. No rest for the weary. With that, we're adjourned.